everyone is doing well, staying healthy and safe. This is Mark Esposito. I am a senior instructor for Kaplan Financial. Been in the business a long time. So if you may hear me refer to myself as an old person, well, I prefer to think of myself as experienced. But what we're going to be doing today is, I hope everyone is enjoying our April complimentary webinars. Today's is going to be on trading securities. As I look out my window here in the Chicago suburbs, we've got about 2 inches of snow on the ground, so it's a crazy April. But what we're going to do here, we thought, because of all the crazy things going on in the world, we at Kaplan, since we are the largest securities education provider, we thought what better way to help our students and our potential students is to have these complimentary April webinars. There are going to be 4 left. Next week, we'll have type of risk on Monday, suitability on Wednesday, economics on Friday, and then I'll be back to, on Monday the 27th, the anatomy of a question. What we're going to try to accomplish with that is replicate what a lot of us do in our live classrooms. I always try to go, and I teach all the classes that basically Kaplan offers, except for some of the more esoteric ones, but I teach the 3, the 6, the 7, the 65, 66, the 63, the SIE, 9 and 10. I've been trading options longer than I've been actually in the business. So speaking of options, by the way, I wanted to remind everyone that because I'll be doing the presenting, I won't be answering the questions. Who you will have there doing that is in the capable hands of my boss and the boss of all our instructors. And in fact, she actually did the options webinars, Giggs Taylor Stevenson. I was moderating for her 3 options seminars. So most of you I've either dealt with as the moderator answering questions, or back I did the first presentation on primary and secondary markets. So what we're going to be doing today, everyone, is I'll be presenting. And again, it's 90 minutes, everyone. Remember, we're going to go till 1:30 Central Time. So 90 minutes, Giggs will be answering the questions. Obviously, I will not do that because I'll be doing the presenting. But if you have questions, please direct those to Giggs. Now, when you do ask a question, please, if you can, give the slide number. I can tell you from all your fantastic responses to Giggs Options seminar, I was about 5 to 7 minutes behind answering questions. So that's why we want you to give her the slide number, because I may be on slide 20, but your question may refer back to slide 15. And frankly, she's going to be answering questions, so it's much harder for her to keep up with the presentation. She can, because she's the boss, and that's why she is the boss. I've had a couple students tell me that she should come out of retirement to do some of these classes and webinars, and she used to do all of them. But so I want to thank her for taking care of that today. So today, everyone, again, today is all about trading securities. Okay? So let's get the slides moving here. So what are we going to accomplish today? After this webinar, you should be able to review and understand the investor's market attitude, define various trading terms, understand the components of a discretionary order, recognize the role of a broker and a dealer, and identify the various types of orders and when they are used. All right, everyone. Now, I want to just go into how I instruct, and I've been doing this a long time, over 20 years just in the instructing side, besides handling all the other jobs in our industry over the years. These webinars are obviously going to cover all of the different exams. We have people on this webinar, SIE, 6, 7, 65, 66. So we're covering some of the broader topics that you could see in all the exams. We're not going to drill super deep, all right, everyone? But one thing I've learned doing this for as long as I have is the best way to remember things is to keep it simple. I'll be using examples. Try to be as real world as possible. We'll try to give examples. We'll try to give you shortcuts. And I don't mean shortcuts like you don't have to study. Of course you do. You've got to go through the materials. You've got to go through the Q bank. But what I mean by that is if we can give you an acronym to remember something, or a shortcut to remember something that you have to memorize, like 30 days or 45 days or something like that. We'll try to do that, all right, everyone? That's what we're trying to accomplish here with these webinars and what we're trying to do overall. So, let's get into it. What are we going to talk about first? We're going to talk about buying and selling. And this is actually kind of a review from my earlier primary and secondary markets webinar back on the first one back in, I forgot when that was. It seems like a long time ago, April 1st. And if you like these slides, everyone, it's because the boss, Diggs, put them together. Who doesn't like a good bull or a bear? But that's a key point, actually, when you think about it. Why? Because in the FINRA NASA exams, do you think they give you straightforward questions all the time? Of course not. Now, we're going to cover this, obviously, in the anatomy of a question in a couple weeks. But this pervades through all of the exams. Every question's not just black and white. It's not what they do anymore. So here, we really need to remember, if someone's bullish, they want the price of it, whatever it may be, a stock, a bond, a bottle of water, a house, a car. A bull wants the price to go up. A bear wants the price to go down. It's an important point that pervades or goes through all of the exams, everyone. And we're going to use certain types of orders to either establish or close a position. Now, think about that for a minute, everyone. When it comes to trading, there's only two things you can do. You can buy or sell. And there's also two other things you can do. You can either open a position or close a position. I call that 2 by 2, right? That's a total of 4. You can either open a position or close a position. You can either buy or you can sell. So I've merged those together, and I want everyone to write this down. We don't put everything down in a slide because then you look at it. And that's a great way to learn, right? Seeing and hearing. You know the best way to learn something? This is proven. This has nothing to do with securities exams. This is about any type of exam or any kind of subject. The best way to learn something is to see it, to hear it, and for you to write it down. So I want you to write some things down. You will get a copy of this webinar. If you registered it, you'll get a copy of the webinar. All right? So you'll be able to take notes. Because I know Gage is going to get questions about, hey, how do I get these slides? Or how do I get on the webinar? Well, you're not going to get the slides. You're going to get what? you'll be able to view the copy of the webinar. And then you can see the slides, okay? But again, the key point I want to make here is I want you to write this down. So, now, I'm going to give you the acronyms. The acronym BTO. Write down BTO with an arrow to the right. BTO, arrow to the right. The letters BTO with an arrow, draw an arrow to the right. And then after that arrow, put down STC. Don't worry, I'm going to tell you what they mean. And right below that little line, I want you to write STO, arrow to the right, BTC. Why is that important? Well, you know why that's important, because those stand for buy to open, arrow to the right, sell to close. Or sell to open, arrow to the right, buy to close. As simple as that sounds. I think everyone on this webinar understands exactly what I did. But do you think your brain's going to be in the same spot in question 3 as it may be in question 117? If you're doing, say, a 65 exam, 3 hours later, do you think your brain's all ready to go? Oh, I'm ready to go. When we start, we always are. But I've had students who told me by the end of the exam, they didn't even care what they were getting on the exam. They just wanted it to end. So everyone realize that these may be simplistic terms, but you never know when you're going to get that question, when your brain's, boom, ready to go fresh, or at the end of the exam when you're a little beat up mentally and physically. So keep it simple, everyone. Buy to open. If I buy to open, BTO, there's only one way to close it, STC, sell to close. But if I sell to open, STO, there's only one way to what? Close it, buy to close. And that's important because when we talk about these orders later, that's the type of question you're going to get, and they're going to ask those questions. And they're going to do it in a what? Perhaps a confusing way. Remember, these are the exams that give you questions like, all of these are non-exempt securities except a triple negative. I joke with all my students, whether it's a live in-person class here in Chicago or wherever I go, wherever gig sends me across the country, or online. It doesn't matter. I always say this. The way that the exams are now is Mark Esposito. I'm considered a male. I'm a man. But in the test world, I could be said, Mark's not a man. I could be called a non-woman. Some of you, I'm sure, are chuckling at that usually in my class. I get a few. Half the class chuckles. The other half's like, what is he talking about? My point is simply this. You have to be prepared to look at everything from the opposite direction. Mark Esposito is a man, but in the test, I could also be called what? A non-woman. So be prepared for those type of scenarios. Okay, so now we're moving from buying and selling to solicited and unsolicited. A definition term that you need to know for the exam. So what's unsolicited? That's pretty simple. That's when the client calls you. An unsolicited order is when the client calls you. So the client calls you and says, hey, I want to buy 1,000 shares of that hot new biotech, Esposito Biotech, my fictitious biotech that I use in class. And I have to say fictitious because I had one student ask me why I was teaching when I obviously was the CEO of a biotech company. And I was worried about that person passing, but they did. So that's a fictitious company, okay? But when the client calls you, what is that? That's a what? Unsolicited order. Why is that important? Because later on, we're not going to cover it today, but when you take your exams, especially your blue sky exams, your state exams. There's going to be questions because certain transactions are exempt. Again, we're not getting into it. I'm just giving you an example. You need to know the definition of solicited versus unsolicited. So what's solicited? That's when you, as the registered rep, call your client. Hey, Mr. or Ms. Client, buy this company. So know the difference between solicited and unsolicited. What about discretionary? What the heck is discretionary mean? Well, and I'm going to prepare you for this, everyone. Discretionary, we're going to talk about the 3 A's, but next to the word discretionary, if you can imagine, or on your piece of paper that you're taking notes, put down this 3-letter acronym, please. POA. Power of attorney. I'll explain shortly, but just write that down for now. POA. So what discretion means is this. Got to remember the 3 A's. Action, amount, or asset. Action, amount, and asset. Not or, and asset. Sorry about that. And what this simply means is, everyone, action, amount, and asset, the 3 A's. If your client calls in and gives you all of the 3 A's, that's not a discretionary order. That's a plain old order. So, action, amount, and asset. I have a phrase that you may want to write down, because I will tell you this. Sometimes, and I've probably only given these presentations 2,000 or 3,000 times, I'll go, when I'm in class, I'll say, all right, everyone, remember the 3 A's, action, amount, and I forget the 3rd A. Everybody has that happen to them. Heck, you'll all be taking your exams, and for good chance at least once during your exam, for 3 seconds, you'll forget your name and what you're doing in front of this monitor. So it happens. So action, amount, and then I can't remember the 3rd A. So I thought, what's a better way to make sure everybody understands that or remembers the 3 A's? How about buy 100 shares of Esposito Biotech? Buy, action, 100 shares, amount. I could have said $5,000 worth too. And what? Esposito Biotech was the asset. Buy 100 shares of Esposito Biotech. Now, why are we making a point of this? Because if you, as a registered rep, chooses, or your clients want you to choose one of the 3 A's, not all of them, just one of them. You can choose all of them. That's not the point. The testable point will be what? If you choose one of the A's as a registered rep / agent, whichever they refer to you in the exam, well, you can't do that unless you have a discretion form signed, which gives you a limited power of attorney to trade for that client. So think about it, everyone. You're going to be able to make trades for your client without their what? Input. Why? Because they signed a form allowing you to do that. That's called discretion. On these exams, from the SIE to the 7 to the 63, 65, or 66, or 6, you're going to get a question or two on discretion. You need to know, you need to recognize what it is, and as importantly, you need to know what? You have to have a form signed before you can act. All right? So let's go through a couple examples. So we have a client order. And we're going to decide, is it discretion or non-discretionary trade? So we got what? Buy 1,000 shares, of Esposito Biotech Inc. at the market. Is that all three A's? Oops. Sorry about that. There's our buy. There's our action. There's our amount. There's our asset. So everyone, the client did what? They gave us all three. So is that a discretionary order? No, it's a non-discretionary order. Why? Because the client gave me all three A's. How about this one? Client says, hey, go out and buy 1,000 shares of whatever, of any biotech company. Is that a discretionary order or a non-discretionary order? Well, let's see. Action. Yeah, the client gave us the action. Hey, they gave us the amount. Did they give us the asset? No. It's not a specific asset. You have to have the specific asset. If the client says, go buy a biotech, well, there's only a couple thousand biotechs. You're choosing, as a registered rep, you're choosing the asset. So what do you have to do? You have to have a discretion form signed, because that's technically discretion. How about this one? Please invest my $10,000. That's a discretionary order. Why? Because all you did was give me the amount. You never gave me the asset. You never gave me the action. And last but not least, buy 1,000 shares of Esposito Biotech when you think the price is right, meaning you, the registered rep. Well, buy. There's our action. How about our amount? Yeah, that's there. And our asset's there. Sweet. The client gave me all three. So that's a non-discretionary order. I don't need a form for that. But some of you are going, well, wait a second. I'm choosing price or time, and time in this case, when you think the price is right, which is actually price and time. Okay? Think of it this way. Does the word price or time begin with an A? The answer, no. So you do not have to worry about a discretion form to be signed prior to the what? Execution of the trade when you determine price and time. It's as simple as remembering that neither of those words begins with the letter A. Now, we're going to talk about quotes. Why? Because, well, everything in our world revolves around what we're going to pay for something and what we're going to receive for it if we sell it. So, in our industry, we've got a bid or an ask or offer. A bid or an ask or offer. So bid is on the left side, ask or offer is on the right side. And I brought in my gentleman a little too quick there. I should have just left bid and ask. I want to make sure everyone understands that this is another example of our industry. Ask and offer are synonymous terms. So you have to do what, everyone? Be prepared when it comes exam time, because the test question can use either term. Okay? So, what everyone needs to get across here is that the ask or offer is the price where the client buys. If the client wants to buy this stock, they're going to pay $29.30. If they sell that stock, they're only going to get what? $29.10. So they're going to, if the client at the exact moment, if two people, one client wants to buy, one client wants to sell, the client who what? Buys will pay $29.30 a share. The client who sells would only get $29.10. Don't ask about fairness. That's not fair. Well, yes, it is, and I'll explain shortly. What you need to know is the client always buys at the higher price, the ask or offer, and sells at the what? Lower price, the bid. And that difference is called of 20 cents, by the way. You get that question on the exam. But they won't use the term difference on your exam. They call that a spread. So the spread on that quote is $29.10 by $29.30. Again, everyone, please remember, the client buys at the ask or offer, the higher price. They sell at the lower price. Some of you, and I don't have the question pane open because I don't want to be distracted by it. That's what Biggs is there for. But I'm sure that there are some people going, well, wait a second. I'm having a hard time processing that. Mostly people who are new to the industry. The reason it's that way is because think about it from the other side, everyone. If you're a broker-dealer, you would what? You'd buy at the bid and sell at the ask or offer. So what do you have to do? You only have to remember one or the other, from the client side or the broker-dealer side. Why? Because if you remember one side, the other side is what? The exact opposite. So I'm not concerned which way you remember it, as long as you remember the clients buy at the what? Ask and offer, the higher price, and sell at the lower price. And some of you, again, may have asked, why is it that way? Well, just turn it around. The broker-dealer would buy something for $29.10. Well, they're in business to make money. The only way they'd make money is they what? Sold it for a higher price. So from the broker-dealer standpoint, they buy at the bid. So one of my short little tricks I usually say in class, and a few people use it, is just remember the 3 B's. The broker-dealer, the first B, buys, the second B, at the bid, the third B, the 3 B's. Speaking of broker-dealers, does everyone, you've got to understand on the exam, they're going to ask you questions about the functions of a broker-dealer. Now, most clients, the vast majority, don't understand the function of a broker-dealer. They're very distinct functions, acting as a broker and acting as a dealer. You work for a broker-dealer. Believe it or not, your firm and you yourself will actually have 2 distinct functions. So first thing we're going to do is look at the broker side. And the broker, when I ask this question, no matter where I go in the country, I was in Boston and New York earlier this year. I was just down in Florida a bit before everything went crazy with the virus. And no matter where I go, I've gone to Oklahoma City, Salt Lake City, Troy, Michigan, Milwaukee, wherever I go, I ask people, what's the first thing that comes to your mind when you hear the word broker? And then the majority, the number one answer I get is a real estate broker. Everybody knows how a real estate broker works, right? They bring buyers and sellers together. Well, what do you mean they bring buyers and sellers together, Mark? How's it going to ask me on the exam? Well, watch. When you're dealing with a broker, you have to remember your ABCDs. Everyone, you've got to remember your ABCDs. So a broker has agents that form an agency relationship that work for a broker that charges commissions that are disclosed. So if any of you on this webinar have bought a home or sold a home, you know that what? You dealt with a real estate broker who had agents working for him. They charge you or the person you bought the house from commissions, and that's disclosed. And I know it's disclosed. Why? Because all I got to do is look at the bottom of my closing document, my RESPA statements. All of that's disclosed. Now compare that to a dealer. And the number one answer I get when I ask about dealers around the country is a car dealer. So you got to remember your DIFM. And I'm sorry, everyone, that's the best I could come up with. I tried to rearrange the letters, but that's the best I got. A dealer who sells out of their own inventory, acting as a principal, charging markups or markdowns. So think about this when you go into a broker deal or when you go into a car dealer. What does a car dealer do? The salespeople do when you walk into the lot or into the building. Do they tell you, oh, hey, if we can't find you something, we'll send you across the street to our competitors? Of course not. What do? They try to sell you something out of their own inventory. And that's important because they don't charge commissions, they charge what are called markups and markdowns. And what that means is simply this. You go out and buy a car, and the sticker price is $25,000, and you offer to pay them $500 over their cost, whatever their cost is. And you ask them, hey, what's your cost? Are they going to tell you what they paid for that car? Of course they don't. That's called a markup. Could be a markdown if they're buying your car from you. You're selling it to them. Markups and markdowns. Everyone, I think, can remember the broker side. You remember a real estate broker. The dealer side, you remember a car dealer. Now, I know some of you on this webinar are thinking, great, this guy told me about cars and homes. How's that helping me on the exams? And if you're thinking that, everyone, or the people that are thinking that, and I don't think too many people are, but I'm going to make this point anyway for the exams, if you're thinking, how does this help you, cars and homes? Well, it helps you because it doesn't matter if it's a car or a home. It could be a stock. It could be a bond. It could be anything, everyone. The principle is the same. So think of it this way. Apple, it's the most widely held stock in the United States. Every broker-dealer in the test world will have Apple in their inventory. So what? You get a test question. They're going to ask you what capacity are they acting on, a broker or dealer side. Well, Apple is going to probably, in 99% of the time, they're going to be acting as a what? A broker or dealer side, everyone. The dealer side. Why? Because they're selling it out of their own inventory. They have Apple. They bought Apple and they have it in their inventory. They're acting like a car dealer. But what if someone wanted to buy 1,000 shares of Esposito Biotech? Do you think a broker-dealer is going to have some small little biotech stock in their inventory? No. What are they going to have to do? They're going to have to go out and find it. Well, they're acting not as a dealer. They're acting on what side, everyone? The broker side. That's why it's important, because come exam time, you may, in a long question, they may just give you the words markup and agent, or commission and inventory. That's why you got to remember your ABCDs from your DIFMs. You remember those, you'll answer every one of those type of questions correctly, which is the whole point of all of this, correct, everyone? I would hope so. Now, what's inside the market? Well, inside the market, we're starting to deal with someone called a market maker. Now, remember, everyone, on the last slide, we talked about the dealer function, right? When we had it in our inventory. All market makers are acting on the dealer side. Why? Because if someone said to you, what's a market maker? I don't know, I'd probably be a wise guy and say, well, a market maker, gee, what do they do? Oh, they make a market. They're the ones that have it in their inventory. When someone wants to buy, they what? Sell it to them. If someone wants to sell, they do what? They buy it from them. They're they're the ones in the middle. When everybody's buying, they have to do what? Sell. When everybody's selling, they have to buy. That's what a market maker does. So anyone ever think about how I came up with that quote, or how we came up with that quote earlier when we did the quote 2310 by 2910 by 2930? Well, what happened is we had a group of market makers who had their bid and ask prices in. And in this example, we have 3 of them. But for a stock like Apple, there's thousands of market makers. So what does inside the market mean? What it means is you've got all these market makers with their bid and ask in. What inside the market is, it's the highest bid price and the lowest ask price. So when you go to a computer screen and see a price of 2910 by 2930, that's not just from one market maker. That's of all the market makers amalgamated together, and that's what? It's the highest bid and the lowest ask or offer from the market maker. And you know what that is? That's called giving the best price to the client. The narrowest spread. Notice that spread's 20 cents. It's the narrowest spread possible. Market makers, they buy at the bid and sell at the ask or offer. Remember, I went through that a minute ago, or a couple minutes ago, actually. Now we're going to get into our orders. And this is a bulk. This is the bulk of our webinar. It's over half. We got 45 minutes left. We're about halfway through. And the rest is just going to be on orders. I wonder why we're doing that. Maybe because it's a large part of the exams, no matter what exam you take. These are one of the subjects, everyone, that you'll find on every exam you take. We all know that the blue sky, the 63, 65, 66, the state exams have more laws in them. Yes, because they're by the states. They have the state securities laws. But every exam, I don't care what you take, has trading questions, because trading is the crux of what our industry does. So we're going to talk about market and limit orders first. They're the easiest orders, which usually means you won't get as many questions on those in the exams, right, everyone? They don't give you the easy questions. They'll give you a few, but 60% of them are going to be harder subjects. So, but we can't get to the harder ones till we understand the easier ones. So what's a market order? Start off with a market order. That's executed immediately at the best available price. Now, what does best available price mean? That's one way to say it. You know what another way to say it is? Whatever the next price is. Whatever the next price is. Think about that, everyone. Market orders. You put an order in to sell or buy at the market. You're not putting a price in. It means you're going to get whatever the next trade is based on whatever the next price is. Some of you may be going like, well, geez, that could be crazy. How do I know what I'm going to get? If you're asking that question, congratulations. You're well on your way to understanding. Because that's the whole point. A market order could be executed if the stock was trading at $30. The next price theoretically could be a penny or $5,000. It's whatever the next price is. But just think about it. Is that good if the market's crashing, like when we had the meltdown a couple of weeks ago? Some people may have said, I just want to get out. I don't care at what price. That's the crux of a market order, everyone. The price is not guaranteed. You're guaranteed execution, but you are not guaranteed a price. Sometimes I call it simply just get me the heck out of this position if I'm selling in this crashing order. Or theoretically, if Esposito Biotech we just came out with we just said we're going to be able to cure some disease, or we came up with a vaccine for the COVID-19, well, then I might put a market order on the upside, because I don't care what I buy, because this thing's going to the moon. So price is not guaranteed, but execution is. That's important, because that is not how limit orders work. Limit orders execute at a specified price or better. I'll get to that in a minute. Buy limit, sell limit, we'll explain shortly. Or better is the key two words for limit orders. But the key with a limit order is, is this, everyone. A limit order, I am not guaranteed execution, but I am guaranteed a price or better. So I'm guaranteed a price or better, but I am not guaranteed execution. And for those of you asking, is there something that guarantees execution and price? The answer is no. You can get one or the other with these two orders. There is no order. There's no holy grail order out there, everyone. So let's look at the limit order. Executed at a specified price or better. What does a or better mean? Well, buy limit, it's the limit price or lower. Sell limit, it's the limit price or higher. And those are just words. One thing I found teaching the hundreds and hundreds of classes and tutoring and things I've done in my career is words like that tend to be mixed up. So let's use what I like to call common sense. Use that 12-pound thing on your shoulders called your head. Everyone, if you were going to buy, I'm an ex-golf pro. I played the tour for a couple years. I like to buy putters. So if I wanted to, buy a putter, and the price was $200, and I said, you know what, I'm not paying $200. I'll pay $150 or better to buy that putter. What does that mean, everyone? That means what? I'll pay $150, but I'd like to pay what? Less than that. So don't worry about the words. When it comes exam time, everyone, the words can be mixed up. Bring it back to a common sense example that you can use while you're sitting in that chair. And if it helps to remember me buying a putter, well, if I'm going to buy something, I'll pay $150 or better. Doesn't mean $150 or more. No, I don't want to pay more. I want to pay what? Less. Just like if I was selling an old putter for $75 and I said, hey, I'll sell it at $75 or better, what does that mean? Well, I'll take $75, but I'd love to get what? More or less? More. So, buy limit order. So let's use an example that you'll see in the exam. If an investor wishes to purchase shares of a stock, the order would be placed. So here we got support and resistance. Now, don't worry about this for the exams right now. This is a technical analysis, but we just kind of use it as an example. So I want to purchase shares of stock. I want to buy. And the current price of that stock is $70. Would I want to pay more or less than $70, everyone? I would want to pay what? Less than that. So the stock's trading at 70, I would put a buy limit at 65. Buy limit, BL. Now, I mentioned acronyms earlier. Well, this might be the most famous acronym in our industry. When I took my exam way back when, before most of you were born probably, this was in my testing materials, my education materials. Sell limits, and I apologize, I was getting ahead of myself. That'll come after the next slide. So sell limits. If an investor wishes to sell shares of this stock, the order would be placed what, everyone? So what? The current price is 70. If I want to sell it, do I want more or less than 70 if I'm selling? I'll take 70, but I'd like what? More, above 75. So we just went over a buy limit and a sell limit. Now, this is where the acronym comes in. You have a line, current market value or current market price, either way. BL stands for buy limit. SL stands for sell limit. So you remember the line is the current market value. The buy limit is below it. The sell limit is above it. We're going to finish this as we go through the material here, okay, everyone? The key point I want to make about this again is it's all about keeping it as your mind as uncluttered as possible to take these exams. Again, this will be covered in my 90 minutes in a week from Monday, 10 more days, when I do the anatomy of a question. But I want to make sure everyone understands that if you can remember something a simple way versus a complicated way, which one do you think you're going to remember during that test when you have that added pressure of taking the exams? So we just did market and limit price. We're going to now do our third type of order called a stop order. This is the order that, in all probability, if you get a question of why an order is being made, is being created, why are you creating this order? 85% of the time it'll be based on the question will be based on a stop order. Why? Because stop orders are probably the most useful orders you can have. They could be used for the following: limit losses, protect the gain. I want to stop there for a minute. Limit a loss. Think about it, gang. Common sense. I buy Esposito Biotech at $10 a share. It could go up or down. I hope it goes up. But if it goes down, will I ride it down to zero? No. What might I say? You know what? I'll accept the 20% loss. So if it gets down to 8, I want to get out. I'll take my loss and run. Trust me, I've been trading options for a long time. Sometimes the best trades I've ever made are when I took a small loss. Why? Because it kept me from what? Taking a big loss. And you'll get questions like that on the exam. But how about protecting profits? How do we protect profits? Well, if we were on Giggs' seminar last week on hedging option strategies, we would have used a what? We would have probably bought a put if we were long Esposito Biotech. But we're not there. We're what? On orders now. So how would I protect the profit? So I bought Esposito Biotech at 10. It's now at 30. But maybe, everything doesn't go up all the time. Maybe I should protect my profit. Sure. So what might I do? I might put a stop order in at 25. So I bought it at 10. It's now at 30, but if it what? Starts to come down, do I want to ride it all the way back to 10? No. I may what? Put a stop order in to protect my profit. And then the third one, you can use it to actually create positions. Obviously, the first two are closing transactions. How do I know that? Well, I have to be in a position to limit a loss or protect the profit. But I can use these orders to actually get in positions and usually technical analysis. And we're not going over that today, but most of you will see that in your exam somewhere. Technical analysis uses these orders to get into positions. The key with a stop order is it's a contingent type of order because it's two parts. Once we get to our stop price, it'll be triggered into a market order. Everyone, remember that. Stop orders trigger into market orders. Here's an example. So an investor sold 100 shares of ABC short at 83. So gang, remember, we opened a position by selling short. Selling short is not buying. When we buy stock, we want it to go up. We're bullish. When we sell it, we want it to go what? Opposite of bullish is bearish. We want it to go down. So we sold it short at 83. So we sold it at 83. We have to buy it back, hopefully at a lower price. But I don't want to be at risk of losing money if the stock goes up. Now, for those of you going, well, I'm not going to get this question on the exam. Yes, you will. You'll almost invariably, everyone pretty much on this call will get at least a shorting question on their exams. And that's from the SIE to the 7 to all the others. So I sold it short. I want it to go down. But what happens? I don't want to be risky if it goes up against me. Because I sold it at 83, I'd like to buy it back at like 63 and keep $20. I don't want it to go to 103. So what would I do? The current market value is $70. So we went from 83, we're down to 70. We've got a nice $13 gain. Do we want to give it back? No. What we'll do is we'll put it in order where? Above. The buy stop is above it. Why? Well, if I have a buy stop of 75, I'm basically saying I'm going to have about an $8 profit. Now, it's not exact. Why? Because that stop is not going to turn into, once that stop price is hit, it's going to trigger into what? A market order. And now this is what you'll see in the exam, everyone. This is what you have to. This is a ticker. This is like a ticker tape. What you see on, a CNBC or Bloomberg. These are prices that'll go across. So we sold this stock at 83. It's now gone down to what? 73. We're going to put a what? Buy stop order at 75 because we don't want it to move against us. So stock was trading at 73. We have a nice $13 profit because we sold it short at 83. 73. We've got a $10 profit. Excuse me. $10 profit. Sorry about that. So we put in our stop at 75. So what happens? We placed it at 70. We entered it while it was what? Above the current market value. And again, I'll go through the shortcut here in a minute. So this is the prices. 74, 75. Remember, we're buying here, gang. 74.90. Have we got to 75 yet? Nope. 74.90 again. 74.80. 75. So what happened? We hit our price, our stop price, which then triggers it into what, everyone? A market order. It triggers into a market order, which then means what? What's our next price? Remember market orders. We have no idea what our next price is. None. Why? Because it could be anything from a penny to thousands to infinity to market order. And our investor has his hands up because he has no idea what price he's going to get. But he understands he's out. And frankly, unless it's a crazy move, he's going to lock in a fairly nice profit. And that's the whole point. That's a buy stop. Now, where do buy stops go? Above the current market value. Again, don't hit gigs up with a question of why yet. I'm going to get to that. Okay? Because as a moderator on most of these, we have the same students. We've got a lot of sharp people on these webinars. And you have a tendency to get ahead of yourself. And I understand completely why. But we probably anticipated 80 to 90% of it. So hang in there with me, everyone. So now we got a buy stop limit order. We've added the word limit to it. So again, same scenario. We shorted these shares at 83. but we really don't want it going against us. Think about it, everyone. I shorted shares at 83. I want it to go down, right? I'm bearish. How high could it go against me? Look up. What do you see? Well, I see open sky. That's known as unlimited. You think it's a good idea? You think clients like to hear, hey, this position, what kind of loss, what's my loss, maximum loss in this position? You think they like to hear the words, well, I can't tell you, it's unlimited. No. So, again, we sold these short at 83. We're going to put a buy, 100 shares at 75 stop. But we added one little 5-letter word after it, limit. It's still at 75. But they didn't have a limit price after that. Wait a second, it doesn't have a limit price. Well, guess what? Sometimes it doesn't. Well, wait. What do I do if there's no limit price there, Mark? How can I answer that question? Some of you probably figured it out already. If they do not give you a limit price after the word limit, and they don't give you a price, you do what? You take the stop price, and now the stop price is the same as the limit price. I've had some students that just put the 75 and they write 75 after the word limit. This is known as, boy, you're a greedy person trade, as I like to say. So let's look at it. The current market value is 73. Again, it's a buy stop, so it's going to go above the current market price, and here's our prices. And we hit 75. Now, one thing, it's what? It's now triggered, right? But it's triggered into a limit order, not a market order. Now, let me make sure I'm very clear here. Do you think in the real world that these stocks exactly hit the prices, the stock price of 75 in this question, for example? Do you think that happened? Of course not. You have to remember what we said earlier. It's at or through. So if that didn't have 75 there, everyone, okay? 74.90, 74.80. Instead of 75, what if it said 75.10? Well, that's at or through. It would still be triggered as long as I get to the number or through it. 75, 75.10, 76, 183. Any of those numbers are 75 or higher, it would have triggered it. And now it triggers it into what? A limit order. And it's a $75 limit order. So what happens here, gang? This is the key test point. 75.25. But wait, I'm buying something. When we buy something, when it's a limit order, because now this has become a limit order, everyone. We've taken a stop limit order and turned it into a what? Limit order. Well, when we're buying something, do we want to pay $75? We'll pay 75, but we'd love to pay what to buy it? We'd like to pay a lower price. Remember, I'm going to buy that new putter for 150. I'd like to pay 100. I'll pay 150 or better, which means lower. So here, this person is not going to pay more than 75. They're going to pay less than 75. I'm thinking some of you already looked at this order and go, well, this isn't so good. I may not get executed. And if you're thinking that, congratulations, you're well on your way to passing these exams. Nope, 75.05, that's not what? That's not better than 75 when I'm buying something. 74.90. That's finally lower than 75. And guess what? I'll get executed there. And our investor is what? He was worried there. Why? Because theoretically, is there a guarantee that that thing will ever see below 75 again? Of course not. The next price, that thing could never see 75 again, and it could go up to what? Infinity, theoretically. So the buy stop and the buy stop limits go above. Now, how about a sell stop? So an investor bought 100 shares of this stock at 52, but doesn't want to be at risk of losing money if the stock goes down. So this is the one that most people think of, right? I buy this stock at 52. I'd love to have it go up. Okay? Buy the stock at 52. Don't worry about support and resistance. Those are just really for only a couple of people on we're just showing you that. The key test point is what we're doing here. The current market price of the stock is 70. Okay? Current market price of the stock is 70. That's the important point. So now, we're going to sell it what? Underneath that. Now think of this, everyone. We bought the stock at 52. It's now at 70. That's an $18 gain. That's good. But there's an old saying at Wall Street that says pigs get fat and hogs get slaughtered. Don't be a hog. So what are you saying? The worst thing you could ever do as an investor is take a position that you made money in and turn it into a loser. So what would you do? I bought it at 52. It's now trading at 70. Well, I'd like to have it go higher. I hope it goes higher, but I'm not going to give back too much of that gain. So I'll put a sell stop in at what? Below what it is now. That way it gives it room to go up still. But if it gets down to 67, I'm going to be out. Don't know what price, but I'm going to be out. And that's the key concept that you have to know for the exam, everyone. So here's the ticker that you'll see. I'm going to sell 100 shares at 67 stop. The stop price is below the current market value. And again, don't worry about that. The acronym's almost done. So here's our ticker. Order was entered when the stock was trading at 68.70. So remember, gang, we're not selling this until we get to what? 67 or through it. So 68.75, 68.90, 67 and a quarter, 67.10. Uh-oh, we're getting close. What happened? It didn't hit 67 exactly. It doesn't have to. It hit at or through. 66.75 is less than 67. So what? It was triggered, sometimes called elected, triggered. Well, what is this? Remember, gang, what does a stop order trigger into? A market order. And we have no idea what price we're going to get, but we're pretty much going to get what? Out. That's the whole point. And last but not least, the sell stop limit order. So it's the same scenario. We bought 100 shares at 52, but we don't want to be at risk of losing money if the stock goes down. Okay? So the stock's up again, right? So it's a sell stop at 67 stop, limit 65. Notice what we did. The last stop limit order we had, we didn't have a price in there, did we? And I told you to do what? If there's no price after the word limit, you have to substitute whatever the stop price is. But here they did give us a price. So look what happens. I call this the leapfrog order. You got to be careful. It's the most dangerous order that you can be tested on. Because what happens? First off, is again, it's below the current market value. It's where we set it. So that bought it at 52. The stock's currently trading at 69. So we put the order in below 69, which is 67. So what happens? All right, starts to go down, goes down, goes down. All right, we're still not 67. Oh, 66.05. That's through 67, correct, everyone? Because remember, we're going down. It's through. So now it's triggered into what? It's triggered into a limit order of 65, meaning we got to get what? At least 65 or more, because we're selling it, right? You sell something, you want to make what? More, right? Hey, I'll take 65, but I'd love to get what when you're selling? You'd love to get more. Wouldn't you like to go and have someone, you're trying to sell your home and the market's 110,000 for your house, and someone goes, I'll give you 130. What are you going to do? Say, nah, you know what? Now the market says 105. I can't take your extra $25,000. What are you, crazy? Of course you'll take it. It's the same premise here, everyone. But here's the key test point. 64.50. Is this person out of the trade? I'm selling. I got to get at least 65 or better, which means more than 65. Is 64.50 more than 65? No. So what could happen here, gang? You get the point? This theoretically could never get executed. What if that stock never gets to 65? Well, unless you change your order, you could write it to theoretically 0. But we don't know what happened. Why? Because we're making a point here. The gentleman is crying. He's not happy because he didn't get executed. Think about it, everyone. If you needed money to maybe put as a down payment on a house or a new car, would you use this type of order? I wouldn't. I'd use a stop order, not a stop limit order. Why? Because a stop order triggers into a market order. At least I'm getting out and I'm going to get some money. But if I do what? If I use this order, I may never get executed. That's not good. And that is a key test point, everyone. Again, it's the reason why I call them the leapfrog orders, because the price leapfrogged from 66.05, it leapfrogged what? Over the limit price. And that's what you have to be very, very careful of. And this is a perfect example, everyone, of what they do on our exam questions. They do these type of things to really, really what? Confuse you. Okay? Now, let's wrap this up in a bow. Self-stop and self-stop limits go below the current market value. Now, that's a pretty handy thing to memorize, wouldn't you say, everyone? Now, think about this for a minute here. So what do you memorize? Well, you got to remember the first letter is either sell or buy, which should be pretty common sense, wouldn't you say? Sorry about that. Take a swig of water. Right? Buy or sell. The second letter is either what? Stop or limit. Stop or limit. So if you could remember that the SL and the BS and the BSL go above the current market value, and the BL and the SS, oops, I got to hit one more here, SSL, go below the current market value, current market price, I think you'd be good, wouldn't you? But here's the problem with that. That's not easy to remember because that's kind of a hard acronym. I always like to say when I do especially a live class, in-person live class, I go, well, that's kind of hard to remember because the acronym for that would be what? Blissful. Wow, what the heck is that? Well, somebody a lot smarter than me thought about this a long time ago. They just put these vowels in, and the vowels mean nothing. This is kind of like Wheel of Fortune with Vanna White and the vowels, everyone. The vowels are only placeholders. Why? Because you'll never forget the term slob's bliss. Trust me. I've been in the business a long time. Started way back in the 80s. And if I am walking by and I hear the term slob's bliss, from someone talking, I know exactly what they're talking about. Why? Because you never forget something like that. Slob's bliss. And students laugh all the time. I go, what's the objective of you taking this exam? Is it to learn the industry? Yeah, you'd like to learn things. Of course you would. But I would hope everyone in this webinar, and I mean everyone in this webinar, has one goal: to pass. You want to learn the industry? Your broker-dealer will tell you exactly what they want you to know and what not to know. The key is to pass. As I like to say, no matter what the passing grade is, let's say the passing grade for your exam is 72. I would tell you this: 72% equals 100%. And I don't think I'd get anyone arguing with me. Back in the old days, before October 1st of 2018, when they used to give you a score for both passing and failing. You get a score for both passing and failing. Now they just give you a score if you fail. Gee, thanks a lot. Can't you tell me at least how good I was when I passed? They don't do that anymore. But I can tell you, when I taught, and I would teach all the classes, I'd have the 7 students, and then I'd see the same people in Chicago area for the 66. And they'd come to me and they say, my boss was really mad at me. I go, why? You passed. And yeah, but my boss, she told me I got a 78. Passing score was 72. I go, why was she mad at you? Because she said I overstudied. Well, I can see her point, not very well, but she's not incorrect per se. The whole point of this, everyone, is the point I'm simply making, is that it doesn't matter. Just get the question correct. That's not cheating. Okay? That's not cheating. Cheating is when you have a tattoo put on your arm, and inside your tattoo is investment company information. That's cheating. And for those of you chuckling, like, geez, what the heck? Who would ever, that's a made-up thing. No, it's not. 2 months ago, they busted a guy in New York. They caught him up. I think it was New York. Diggs is from New York. You'd have to verify that. But they busted a guy who had a fake tattoo on his arm, or a real tattoo. I don't know which. Hopefully it was fake. But he kept looking at his arm during the test, and they caught it on the monitors, on the cameras. And inside his tattoo was information. That's cheating. This is not cheating. Slob's bliss will answer any question about where do you place orders. Where do you place orders? You get a question on your exam, where do you place an order? If you remember Slob's bliss and the line in between is the current market price, you will get it right all the time. That's the goal at Kaplan. That's our goal. That's my goal. That's your goal. Back to our order ticket. Now, there's some qualifiers. We call these order qualifiers. We're winding down here, everyone. So, what's a day order? This is one where I have to laugh sometimes. Sometimes the answers are as obvious as they sound. A day order is good for, let me think about this. I knew I remembered this somewhere. Where was that in my exam? A day order is what? It's good for the day. At the end of the day, it's canceled if it has not been executed. The other key test point about day orders, everyone, is simply this. It will not use the word day after it. If there's nothing after the order, like all those orders we saw earlier, none of them had the word day after them, did they? None of them. But they're all day orders because they didn't have anything after that. If there's nothing there, it's only a day order. The next day, it's good for only that day. It does not go into the next day. You'd have to re-enter the order. If I wanted it to go to the next day, I'd have to put in what's called a good till canceled order. or on the exam questions, you'll see it you'll never see good till canceled in an order. You may have it spelled out there, but in an order, like we saw earlier with our earlier questions, when we said none of those examples we gave in our tickers for our stop and our limits, none of those were good till canceled. Why? Because you didn't see the letters GTC. GTC, good till canceled. Unless you see GTC, it's a day order. Good till canceled means it's good until it's canceled. Oh, that must mean it goes in forever, right? In perpetuity. No. What it means is good till canceled orders will stay in effect until they're either executed, A, B, canceled by the client or you if it's a discretion order, but now we're not going to get into that, forget that. But the testable point is C, when the system automatically cancels them in the last trading days of April or October. So the system automatically cancels all good till canceled orders on the last trading days of the month of April and the month of October. So what's testable? Last trading days of those 2 months of April and October. Not the last day. I don't mean April 30th and Halloween, October 31st. What I mean is the last trading days, which is what? Monday through Friday, except what? Holidays. Okay? We'll finish up here with trade settlements and confirmations. Trade settlements. What does settling mean? What the heck does that mean? Well, let's just memorize the numbers first, and then I'll explain. TD stands for trade date. SD stands for settlement date. It's T plus 2. It's called regular way settlement, T plus 2. The 2 stands for business days, everyone. It's 2 business days. So it's the trade date plus 2 days. On the exam, you'll see it shortened to T plus 2. That means 2 business days. Okay? 2 business days. So today's Friday. If it was transacted today, when's the next business day? Well, that's easy. That's what? Tomorrow, Saturday. No, it's not. It's what? Monday. T plus 2 would be Tuesday. It would settle on Tuesday. If I made that trade on what? Wednesday, it would settle on what? Friday. T plus 2. That's called regular way settlement. And again, I'm going to explain why in a minute. I need you to know if it's a cash transaction, it's same day. If it's a cash settlement, it's the same day. If it's a cash settlement, not a cash transaction, a cash settlement. Same day. Okay? Everything in our world is T2 except for U.S. government securities, which is T plus 1. Now, options are also T plus 1, but we didn't really want to get into that now, so don't worry about that. But it's probably just easy to remember that everything's T plus 2 except what? Government securities and options. But I want to go back real quick to a bigger point, so to speak. What the heck is settlement in the first place? I don't get that. Yeah, you probably do, but you didn't think about it this way. So think of it this way. If you were to you went on your computer and bought 100 shares of Apple right now. And you bought them from who's ever on the other side of that transaction, the counterparty, the person on the other side of the transaction. You're both whatever. You don't know who that person is. They could be halfway around the world. Let me ask you something. Are you going to give your money to that client Are you going to send them money? Are you going to give them money theoretically before you receive the shares? No. They're going to go, wait a second, send me the shares first, and then I'll give you the money. And that person is going to go, no. You send me the money, and I'll give you this, and I'll send you the shares. It's a standoff. Well, nobody's going to do anything. Well, settlement means there's somebody in the middle that's clearing and settling the trades. That's why it takes 2 days. Why? Think of it this way. I'm going to buy 100 shares of Apple from one of you. I'll send my money to the what? To the broker-dealer that I'm dealing with. They will clear and settle the trade. They'll wait for you to send the shares to them. They'll then have both of them in their possession, and they'll do what? They'll then send me the shares I just bought from you, and they'll send you my money. Hey, it's a middle person. It's a broker-dealer. That's called clearing and settling trades. If we didn't have that, nothing would ever be done, because you're not going to trust the person on the other side of the transaction. That's called clearing and settling. That's why it takes 2 days to settle trades. Okay, T+2, that's the testable point. And last but not least, all these things that we just talked about today, orders, the settlement dates, all of that has to be put on a trade confirmation. A trade confirmation tells the client exactly what happened, what securities were bought, at what day, at what time, at what price. What are you acting? What capacity are you acting? All of these are on a trade confirmation. The key testable point, and you can see all the different things there. Don't worry so much about the flow, even though that's an excellent flow that Gates put together. That's more Series 7. That's only going to really be on a 7. But what's not going to be on a 7, it's going to be on everything, is you got to remember a trade confirmation can be delivered no later than the settlement date. That's the key testable point, everyone. All right? That's the key testable point, delivered no later than the settlement date. Okay? So, that's it. I want to thank everyone for being on this webinar. I know Giggs is going to have to beg off the questions in about 2-3 minutes. I will come in and answer any straggler questions. I'll leave it open for about 5-10 minutes afterwards to answer any questions. Everyone, remember, next Monday we've got types of risk. Next Wednesday, suitability. Next Friday, economics. I'm not sure which one Brad and Maria is doing. There are my excellent peers and coworkers. And then I'll see you'll hear, hopefully you'll hear me, on Monday the 27th for the last in our April complimentary webinars on the anatomy of a question. 90 minutes on how to answer these puppies. Everyone, again, I want to thank you. Thank you for coming into our webinar today. Please, everyone, stay healthy, stay safe, and we'll see you in the next webinar. Have a good weekend, everyone.